Warren Buffett just celebrated his 89th birthday recently. Don't be fooled by his age. The greatest investor of all time is just as sharp as he is today than he was 40 years ago. He is still dishing out tips for his disciples to walk in his shoes and become everyday millionaires with the stock market. I was watching his sit-down interview with Yahoo Finance, and just a few minutes in, he already spoke words of brilliance that I think we all needed to be reminded of. I can't tell you how many times people have asked me, hey, I really like StockX. I think it's a good company, but I'm afraid it's going to go down as soon as I buy it. And I don't want to lose any money. Well, you can't have your cake and eat it too. If you want to make money in the markets, you need to take on a level of calculated risk. But what I tell all these people is that they are failing in the research part of analyzing a stock. If you had really done your due diligence and really got into the fine print and know all the ins and outs of a stock, you wouldn't be worried about the stock price in the short term. The reason you're worried is because most people hate losing money far more than they love making it. So much so that they will make bad decisions in the name of avoiding future pain. This phenomenon is called loss aversion, and it was first documented by two Israeli economists in 1984 and is a major influence on investor behavior. You would be aware market conditions are volatile every day and price fluctuations are normal. If you think about it, a stock only reports earnings 4 times every 365 days. That means there's about 200 trading days mixed in there where the stock is just moving sporadically without much rhyme or reason. These could be because of macroeconomic factors, trade wars, investor sentiment, fear-mongering, bad press, etc. Now let's see what Warren has to say about how often you should be checking your stocks.
Let's talk a little bit about Apple. Everyone always wants to talk about Apple, right? It's kind of the it stock, it company. You have a $45 billion stake, more or less. How closely do you follow the company? You know, people are concerned they haven't really introduced any new products.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No. I mean, if you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once. It doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good, and some when prices aren't going to be good. I know there's years when yields will be better than others. What about the farm? It just doesn't. I don't care about economic predictions on or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. Now, in a good year, it'd be 200. I mean, we really make progress in this country. That's one reason commodity prices go back a couple hundred years. They've moved so little is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that.
And so Apple is kind of like a farm.
Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe we'll slow down our sales or anything. No, they'll buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
Warren, off the top of his head, gives a brilliant metaphor comparing owning stocks to owning a farm. In both cases, the investor has to put up some capital, hoping to get a return, and also leaves a management team in place to do the work for them. But the owner of the farm trusts his management team to do a good job because he screened them well before hiring them. There is no point in thinking about it all day or checking up on the farm every day because there is a better use of an investor's time. He also doesn't listen to the news, fear-mongering about the farming industry, and lets the farm team continue to produce. He knows that there are some years where they will have greater returns for their labor and other years where there's not so much. You are taking a risk and putting your faith into the management team of a company to be successful and give you solid returns over the years. Now, it's hard to trust people you've never met in real life, but you can minimize that level of disconnect by being an expert on the company from all the public information they release to the public. The Securities and Exchange Commission, the SEC, requires companies to report their earnings within 35 days of their quarter ending. These earnings reports and calls consist of financial statements that are audited by external auditors for integrity, as well as the management team to give some insight of the company and answer questions via Q&A. Now, the most important question, how often should you check your stocks? And unfortunately, I can't answer that question for you, but I know I check mine every day. Not because I'm happy or afraid if a stock goes up or down, but just because I'm bored waiting in line for food or just checking my phone or want to know what's going on in the markets in case I see some stocks at attractive prices. Whether a stock goes up or down in the short term, that doesn't have too big of an impact on my emotions because I know prior to buying the stock, I did a good screening process and trust the stock, not for tomorrow or next year, but 10, 20 years down the line to keep returning me money. And guess what? Sometimes I'm wrong. It's not realistic to bat 1,000. Stocks that I expected to do well sometimes just do terrible. But that's okay. You can't expect all your investments to always do well. You just have to have more stocks that do good than do bad. If you agree or disagree with me, let me know in the comments. As always, guys, be sure to hit that like button and subscribe to the channel for more updates.